A lot of things confound me about the business. They confound you. Sometimes you get a situation where a company that should be doing very well instead puts up incredibly disappointing numbers. And when that kind of counterintuitive failure happens, I say we take a closer look. Which brings me to the stock of Tyson Foods. That's the packaged meat company that produces roughly 1/5 of the beef, pork, and chicken in the United States. You've bought their stuff. I have, too, along with a host of packaged food brands like Jimmy Dean, Hillshire Farm, Ballpark Frank, State Fair, and others. Fills your refrigerator, sells mine. At a time when we hear endless complaints about rampant food inflation, you'd think companies like Tyson would be able to put up real good numbers, right? I mean, isn't that right in their wheelhouse? We're supposed to be persistently high inflation. It's all we talk about in wages, food, and housing. So bad, the bears say the Federal Reserve needs to wreck the whole economy in order to get these prices under control. In that kind of environment, Tyson Foods should be printing money, right? Yet that's simply not the case right now. Tyson's trading at $63 and change. That's down roughly 37% from its peak in February, down just down 28% just since the end of July. All right, so what the heck's happening here? Is Tyson dropping the ball, a victim of poor management, or is there something else here that we're missing? Maybe the whole food inflation thesis is wrong. Why don't we take a closer look? When you zoom out, this stock is actually doing very well at the beginning of the year. Tyson reported a phenomenal quarter in early February, so good that it allowed the stock to jump 12% in a single session, 12%. And there was absolutely nothing to dislike about these numbers. 24% revenue growth, monster 48% earnings growth, thanks to booming beef business, along with real strength in chicken and prepared foods. It had all come together for Tyson. But just 1 week later, Tyson started getting a wave of analyst downgrades. Downgrades turned out to be 100% correct, by the way. These analysts pointed out that the strength in beef and chicken was already baked into the stock. Then they started talking about deteriorating margins as the beef packing business returned to more normal levels. The coup de grace came in early May when Piper Sandler downgraded Tyson precisely because of rampant food inflation. Here I was thinking this is the one to buy off rampant food. No, it's the one to sell. See, if you thought food inflation was good news for a meat company, Piper pointed out you might be mistaken. Their argument: meat's expensive, so when consumers' budgets get stretched by rising food prices, as we know is the case in our country right now, they're likely to trade down to cheaper stuff. And you can say the same thing about a Fed-mandated recession. When the economy slows down, you see the same trade-down effect. Many food companies are immune to a slower economy, but Tyson's a lot more vulnerable than most. Everybody needs to eat, but they don't necessarily need to eat high-end beef. Now, Tyson still managed to deliver another good quarter in early May, even raising their full-year sales guidance. I thought it looked really good to me. But they also cut their volume growth forecast. So initially, the stock jumped about 2%. I got that. I was sitting right over there at that desk. I said, ooh, looks like Tyson's good. But then it gave back that whole gain over the next 3 days. Over the course of the summer, Tyson's shares continued to roll over, despite there being no particularly important negative catalyst. Sure, the company had some political headaches in May. House Representatives COVID subcommittee accused Tyson and other meat companies of making baseless claims in order to stay open during the lockdown. In August, the New York State Attorney General accused them of refusing to comply with a subpoena for a price gouging investigation. Not great headlines at all. But you know what? I don't think this stuff moved the needle for shareholders. It was just kind of out there. Of course, in July, now this was different, the Wall Street Journal published a very negative piece detailing how severe operational issues were causing Tyson to fall behind in the chicken industry. Plagued by staffing shortages and chick hatching problems, they haven't been able to keep up with the competition in business they used to dominate. Tyson was chicken in this country. When Tyson reported again in August, the results were a lot more mixed. Their sales growth slowed to 8%, although that still came in slightly ahead of Wall Street expectations. But their earnings were a little light, down 28% year over year, with weaker than expected margins in chicken and prepared foods. They even cut their full-year volume guidance. Whoa, forecasts went to 0, down from 1% to 2%. And that's what they previously thought. 0. So in response, wow, the stock got slammed. This thing, Tyson Foods, boring stock, right? It went down 8% in one day. And then the darn thing just kept getting hit and hit and hit over the course of August and September. A few months ago, the stock caught another downgrade, this time from a placid firm called Argus, making the same case we just mentioned. Tyson's been steamrolled by inflation because it's causing consumers to trade down to cheaper meat brands. Why buy Tyson stuff if there's a private label knockoff version for the same kind of thing, right? Didn't help when they brought in a new CFO in September. All right, now this is interesting. But a new CFO in September. He's the 32-year-old great-grandson of the company's founder. You know what? They built him as a, quote, dynamic next-generation leader, only to see him get maybe a little too dynamic 6 weeks later when he got arrested for public intoxication and trespassing after getting drunk and falling asleep in some random person's home. All right, this was in Fayetteville, Arkansas, a town I'm not familiar with. But to be fair to the new CFO, the University of Arkansas had just lost a heartbreaker to Liberty University that day. Plus, there's clearly something in the water in Fayetteville that impacts meat and meat-like industry executives. Just a few weeks before, the now former COO of Beyond Meat bit someone's nose following another Razorbacks game, albeit a clear victory. Once again, though, I don't think that's a needle mover either. What matters more are the numbers. When the company reported its most recent quarter a little less than a month ago, their earnings per share came in light again, this time weaker than expected operating margins in every major segment except for chicken. The beef division saw its operating margins plummet from 22.9% last year to 7.7% in the latest quarter. Brutal. Their pork business actually lost money in the quarter. While Tyson didn't call out one key issue, they mentioned a number of different problems. Higher live cattle costs hurting beef, herd health issues hurting pork. Management also repeatedly pointed out that their new productivity program is already yielding big savings. It saved them $400 million in the 2022 fiscal year. But clearly that's not enough given the state of the business right now. All that said, the quarter wasn't terrible. It certainly doesn't justify the kind of decline we've seen in recent months. But that's because Tyson's been slammed by worries about the future. Between inflation and slowing economy, there's a widespread sense that consumers will start trading down, and that means that they will not buy Tyson Foods branded product. So even though the stock is selling for less than 10 times earnings, and boy, I have to admit, I was tempted. But when we did the work on it, I said, not for me. When a company misses the earnings estimates for 2 quarters in a row, you need to put it in the penalty box. Here's the bottom line. I don't know how badly Tyson will get hit by the trade-down effect, but it clearly will. I say, why take the risk? This thing has become a battleground stock, and I'd much rather you stay away from battlegrounds because there are easier ways to try to make money, especially when the CFO seems a tad dazed and confused after being caught sleeping in a house that wasn't his. Let's talk to Malinsky, who happened to be my former congressman in Virginia. Malinsky.
How you doing, Jim? I haven't talked to you in a while. It's great to hear your voice.
It's been too long. It's been too long. What's going on?
It's been way too long. Hey, I've got a question for you. The consumer's hurting, and right. I've been talking to my channel checks on food and stuff like that and looking at prices. So if I had to throw a stock at you to look at it, and it was down, it was down almost four points today.
Okay.
Treehouse Foods. What are we doing? Food inflation.
Now, Treehouse Foods is it's precisely the stock you're supposed to buy. Precisely the stock you're supposed to buy in this environment because they do have the best trade down. So I'm going to agree with you. I like Treehouse. I think it should be bought. I think you're in good shape. I think it's a great call. And I want to thank you for checking in again. It's great to hear your voice. Let's go to Tyler in California. Tyler.
Big booyah from California. Jim, how you doing?
I love familial booyahs. They remind me of the glory days. What's happening?
All right, Jim. Hey, so I'll make it quick for you. I would like to know if CMG Chipotle is safe for the recession.
Bye. You know something? Some people don't trade down and some people don't stay away. It is a treat to go to Chipotle. The study that I've done, and I've worked a lot on this because of my, I own a Mexican restaurant, is what people do in tough times is they look forward, and we're going to talk about that at the beginning of the show, with Darden and Olive Garden. They look forward to going out at a place where they get a really quality meal and it doesn't cost them a fortune. And that's why Chipotle has historically done well in these situations. All right, now, this is a piece that I came at from a totally different level. I was thinking it's time to buy Tyson, and it turns out Tyson has become a battleground stock. And I'd much rather you stay away from battlegrounds because there are easier ways to make money. Hey, we got a lot ahead, including my exclusive with Nucor. With steel prices soaring this year, how does that set the company up for 2023? And what about this sticky tariff situation? I'll get in the latest from the CEO. Then, it's the tale of two companies, one with high expectations and the other lower. I'm taking a closer look at Costco. And then now the suddenly much despised Lululemon, which I am telling you is good. You stick with me. And all your calls, rapid fire, in tonight's edition of the Lightning Round. So stay with Cramer.